Panel is going to be about the different models of credit information systems and credit reporting systems and their possible impact on credit and generally on the economy. For this panel, we count on 4 super specialists. Matilde, not only in this panel, as in everything else in the conference, has done a fantastic job at assembling a group of extraordinary specialists. After some preparation, I can say, in the case of this panel, also very passionate, and I'm sure we're going to have a very lively discussion. The way this is going to be structured is by means of quick questions, which will be answered by all of them briefly, so that it's dynamic and there's some debate between all of us. I'm going to start I'm going to crack on by just very briefly introducing all of them, so you are acquainted with their specialties. So on my right, I've got Professor Federico Ferretti, who's a senior lecturer in Brunel University in London. He's got a PhD from Leeds, an MA from Sussex, an LLM from commercial law, from Sussex, and a university degree, no less important, at the University of Bologna, which is a university we all very much care for here. To his right, we've got Dolores Cano. Dolores Cano is jefa de división de la Central de Información de Riesgos del Banco de España, where she has worked since 1991, with the exception of a few years where she was at the European Central Bank and the predecessor to the European, before the predecessor of the European Central Bank, and he was for a while, since 2005, head of balance of payments at the bank, at the Central Bank of Spain. So few people as qualified as her to talk about these topics and what's going on right now at the institutional level. To my left, we've got Enrique Velázquez, who, despite looking extremely young, has done a lot of things. I'm going to just summarize some of them. He's currently Director General of the Association of Consumer Credit Information Suppliers. Before that, he had worked at the European Banking Federation and at the CNMV as well. He was also an officer at the Committee for European Securities Regulators, and not less importantly, he is a graduate of the Universidad Autónoma de Madrid, which makes him extremely knowledgeable. Finally, to my extreme left, I've got Martin Schmalzried. I try my best. He's excellent, a very well-known specialist on the topic. He studied in Brussels in the ULB with a degree in political science, and he teaches sociology as well. His background is very interesting. He's mainly been working with the Confederation of Family Organizations in the European Union as a senior policy advisor. So he's also got quite hands-on experience on the topic, and is going to be extremely useful in the debate. So without further ado, let's just move on. I'm going to ask Federico a quick question, which he unfortunately is going to have to answer also quickly. So is the sharing by lenders of positive credit information about their debtors a useful tool according to you, or it does not do a good job and it backfires?
Okay, thank you very much, everyone. I think my initial reaction would be, it depends. Well, I think there is little dispute as to the importance of personal data, especially in economic terms, and it's not by chance that data has been defined as the new oil. And so as to the importance of data, I think there is very little question there. And I think that Professor Padilla has given us a fantastic presentation overview how it's important also to share the data, and especially in this sector. Why did I say then depends? Because the obvious answer would be, well, yes, of course then. It depends on the users. Why? Why do you use the data? How do you use the data? What is the purpose for using the data?
Positive data, though.
I know,
Yeah,
but
yeah.
what is the purpose for doing that? It can be positive, it can be negative. I have an issue in differentiating between positive and negative, because for me, sometimes it's obvious, but some other times this is a neutral connotation. It depends how we interpret the data, how you look at the data. I know there are some set criteria for saying, okay, this is clearly negative, this is clearly positive. Moreover, my issue is when there are no data, is it positive or negative? But okay, I don't want to dig too much into that. What I wanted to focus on is about the uses of the data. Be it positive, be it negative. And as also Maria before us explained us, data can be used for different purposes. She made the example of creditworthiness assessment versus credit risk analysis. These are two different purposes. This has also been recognized by the European Court of Justice in saying in LC Credit Lyonnais and consumer credit cases, it was clearly held that the creditworthiness assessment should be done in the interest of the consumer. Well, then, if we look at Europe, there are very different practices and different uses of the data across the EU. This generates to me the question, so who is doing the good job? Who is doing better than others? And my initial reaction is that this fragmentation in the member states already questions the reliability and especially the proportionality of the data usages in national systems, and there are no uniquely accepted criteria or standards on the use of the data, be they positive or be they negative. There are no shared, no accepted ways of how the data are relevant to achieve defined objectives. First, we need to define the objective. What is the objective of using and sharing data? Once this is clear, then we can probably have a better answer to the question. The question is very relevant. I'm not saying it's not. What I'm trying to say is that in Europe, at least, I think we need further debate and insight. Just to conclude, if I have a few seconds, data are very important, not only for the data protection issues and what it derives from there. That is, as individuals, as people, we don't want to be stereotypized, we don't want to be categorized, profiled, sorted, etc., etc. But it also becomes a gateway, an economic and social gateway for consumers. The data will determine how much we pay for goods and services, and they will also determine whether we can access or not access services. This is all I want to say.
Thank you. It's all very interesting, but can you give me a yes or no to the question whether positive information, in your opinion, is actually positive or negative? Just 5 more seconds.
Ignacio, you're very kind to ask this, but I am relieved that as me, you are a lawyer. So you cannot say yes or no. You say it depends.
Okay, fine. Lola.
You don't like that?
No, that's great.
Well, in my case, I'm going to be a bit more, I'm not a lawyer. I'm an economist for education, and I've been in the field of statistics and data managing all my professional life. So I would say that I think it's actually a positive thing, the data sharing, and particularly in our case, I'm in the Central Credit Register of the bank, which has a long tradition. It was set in 1962, actually with the first, when the Banco de España was being designed as the new as a proper central bank, which actually I think is a very interesting thing to see that even then it was being seen as a key element for the functions of the central bank. Okay, this is perhaps a more limited area that or more a specialized area than the one we are in discussion in here, but it was also from the very first moments, it was also the data sharing within. First, the obligation of the credit institutions to provide data on credit to the bank was already set. It was also set the sharing from the bank back to the system of this data. I'm talking about 1962. It's a long time. And also the possibility for these credit institutions to actually request information on non-clients as to be able to perform better the evaluation of the creditworthiness of the potential. So, I mean, already back then, it had the main characteristics that I think define what is nowadays a public credit register. And obviously, at those times, it has changed a lot. It's already 55 years ago. At those times, the reporting threshold were very high, but already it was requested that the specific characteristics or the negative characteristics of any operations were already reported without any threshold. So I am actually just to give a more concrete answer, so you don't need to re-ask me. I actually believe that the sharing of information is actually a positive thing. I think what Federico has mentioned in terms of it also depends on the users. I'm also a true believer of that. I mean, after the financial crisis, we all have seen this madness in terms of let's get all more data. We didn't have enough data to evaluate what was coming. We didn't actually see what was coming. And perhaps it's true that perhaps we didn't have enough data, but it's also true that perhaps the analysis of those data or the accessibility of those data was not the best one. But this drifts a bit from what we are. In any case, also after the financial crisis, Banco de España started a reflection in terms of the credit risk data that we had, and it was seen that it was improvable. Actually, we have changed it upside down. We have now, since 3 years ago, since the last regulation 2013, the Banco de España Circular 2013 created a new CCR, which is loan by loan based. It's absolutely granular. We have gone from a more aggregated on a debtor focus on the debtor. We have gone more on a focus on the operation, on the instrument basis. Obviously, we can always aggregate by debtor, but like that, we have more characteristics on each instrument. We have. We also collect, and perhaps it's also biased by the way in which the crisis was appeared in Spain. We have many. Data. We have many details on the guarantees, particularly on the buildings and the mortgages market. Well, the only thing perhaps that we don't collect is data on which is the name of the master of the building work. But I mean, believe me, we have many many details on all this, which were a burden for the bank balances. So I think actually this has started 2 years ago. 2 years ago. 2 years of this so detailed data is perhaps not long enough to be able to extract or to analyze those data in detail. But I believe that with this information in there, banks will have very good information on.
I will ask you to keep in mind for later, perhaps, question about who should access that data.
Okay, we'll talk about that later.
Enrique,
yes. Well, I would like to start by thanking the organizers for having invited ACCIS to participate in this panel. Just 10 seconds to explain what ACCIS is. ACCIS is the trade associations that represents the European credit information systems, the credit bureaus. We also have among our members public registers, so we have a mix in the membership between the private and the public organizations. We have organizations that collect only negative information, and we also have organizations that collect both positive and negative information. And I want to explain this at the beginning, because I think going forward you will understand why I need to make this sort of caveat at the beginning. I think going back to the question, I would like to to put us in context somehow. We are in this part of the conference that is under the heading Prevention of Insolvency and Over-Indebtedness. So the way to respond to this question from a credit bureau perspective would be to see to what extent can a credit bureau contribute to curb over-indebtedness or insolvency. And I think the way to do this would be to make sure that an effective credit system is able to reward responsible behavior, because at the end of the day, it is responsible behavior that is going to reduce over-indebtedness. And what is the best way for a credit reporting system to reward responsible behavior? Well, I think the best way to do that would be to take into account positive information, because at the end of the day, that positive information reflects on that good behavior. And therefore, the way to respond to that question is that if we are in the context of preventing over-indebtedness, and therefore we are in the business of trying to also, let's say, reward responsible behavior, yes, it makes a lot of sense to collect positive information, and to collect positive information from as many sources as the law permits, within the limits, of course, established by the laws. And there are beauties in collecting, as I think was explained by Professor Padilla at the beginning of his presentation. There are many benefits in collecting that positive information for entrepreneurs and for individual people. First of all, we see that there is an expansion of credit, and there's a reduction in the price of credit. So that is very positive. And also, I think the collection of positive information is able to address the problem of cross-subsidization between good borrowers and bad borrowers. So overall, I think that the response is yes.
Thank you, Enrique. Martin, please.
Thank you. Thank also for the organizers. It was really great to be here. So thanks a lot. Actually, I'll respond kind of in the line of Federico, but going a bit beyond, in which cases the use of positive data is actually good. So I'd like to focus on, there's always effects in selecting certain data on the behavior of the actors. So we've touched upon it with the presentation of Professor Padilla. Using positive data has certain impacts on how banks behave. One of those impacts, for instance, if you look at the paper I wrote about the Belgian Public Credit Register, is that the banks can more easily identify consumers that have an interesting profile in terms of credit and creditworthiness, which means they can also optimize lending to make sure that all the consumers that are of a good profile are sort of, sold credit up to the limit of what they can actually, hold. So there's a lot of incentive to maximize credit lending to very good profile borrowers, and that is one of the effects that you see when you have a lot of positive data available. And so there's also the impact on those that do not fit the right profile. So when you use a certain data set, there are certain consequences as to who becomes a suitable borrower and who doesn't. And so, it might be great for the people that have a good profile in terms of the positive data, and might exclude others that have not so good profile from accessing certain credits that they need, even though they might be solvable according to other metrics. And so that's why I'm going to go to the second effect. It's an effect on the users, and this is much more interesting. Using certain types of data also influences how users behave, and it was touched on by Professor Padilla. When you have only negative data, users panic and they will do anything to reimburse their credit, because otherwise they'll be in a bad register and they will be excluded. If you include positive data, it creates an incentive to actually take out credit, so you build your credit CV, so to speak. So you can prove to the banks, look, I've already took 10 small loans. Now that I want a mortgage, you can give me a good interest rate. But this means that even though they could have paid for credit for their expenditure with savings, they're going to prefer using credit, because otherwise, once they really need it, like for a mortgage credit, their slate is blank, and the bank, even though they have 50,000 euros in savings or wherever, the banks will say, well, yeah, I have no information about you. I'm sorry, I'm going to give you a higher interest rate. So that is problematic. And so this is where I'm saying it depends how you use positive data and how it is weighted in the creditworthiness assessment. So for instance, if in the creditworthiness assessment, of course, you do include the negative and the positive data, but you, for instance, put more emphasis on how a person has managed their personal finances over the last 6 months or whatever, see what their savings capacity is, see if they have a steady income flow, then you don't, positive data is interesting, but, maybe not as interesting as how responsibly they can manage their finances. If they have a capacity of savings of 500 euros every month, they've shown that consistently, plus they have some savings in their bank accounts, you can just assume that they're going to be, apart from the tiny fraction that are the moral hazard, that people that borrow with the intention of not repaying, which is absolutely tiny, you can assume that there's no reason for them not to repay if they have, certain savings and if they have a steady income. And here I also make the distinction between retail finances and business. Because don't forget that in retail finance, you're lending to a consumer that has a proven cash flow, proven income. So this is completely different than a business that is promising that is going to have a future cash flow because their project is great. They have none right now, but once their business picks up, this is what I intend. This is what I think I'll get, in terms of profits. And the lending there is completely different. So that's why you can rely more on how responsibly consumers manage their finances because they already have an income flow. They just need to sort of smooth out their consumption patterns into the future.
Well, that would be only in the case of startups.
Yeah. So, well, of course, if you already have a business and you just need an extension, that's also a different case. But I was specifically wanted to point that out. So, positive data, yes, it can be good, but it has some side effects in terms of how banks behave, how they lend, in terms of how consumers behave. And so it's about trying to see what is the behavior that we're seeking after. Do we want people to actually take out more credit because they want to, prove to the banks they're solvable? Or do we want people, for instance, to manage their finances more responsibly and, always decide, is it more interesting to actually pay for this new TV with a credit or with my savings? And this responsible sort of financial management. And I'll touch maybe later upon prevention of over-indebtedness and how this might address that.
Before we move on to the next question, I saw a frown in Federico when Enrique was speaking. Perhaps he might want to elaborate a little bit on the frown.
No. It's just a short reaction on the relationship that it was created between the issue of prevention of over-indebtedness and the responsible behavior of consumers when if we look at the causes of over-indebtedness are far from being the irresponsible behavior of borrowers but even of lenders. I mean, I'm not crucifying lenders. The major causes have been found to be external events, lifetime events, unemployment. And there is a big reality, and now I am expanding this topic too much, I know this, but the reality is that wages are very low, are too low. There are problems in labor markets in many member states and in the retraction of the social welfare. These have been found to be the major causes of over-indebtedness, not the irresponsible behavior. And also now to clarify my depends position, if we look at countries where only negative data are processed, take France, for example, we don't have any indication that in France there is a larger problem of over-indebtedness than in other countries, especially if you compare it with the UK or with other countries. But what I'm trying to say is, I'm not saying the contrary, that positive data then are not useful. What I'm trying to say is that probably we are barking at the wrong tree.
Which one would be the right one?
No,
please, you are a central banker.
No.
I wish I had the magic stick, but as I said, there are problems in labor markets, there are problems in... let's look at what the causes of our indebtedness are, and then we can speak frankly about how to best prevent it.
Yeah, very quickly, yes.
Yes, but just on the barking to the wrong tree, and this goes back to what you were saying, what do we want to see as positive behavior and reward positive behavior? And like I said, if Federico mentioned the causes of over-indebtedness, it's true, it's job losses, it's illnesses, it's divorces, but it's also shown that people that have a certain amount of savings on their savings account can actually stomach these kind of economic shocks and go through them much more smoothly than people that have, even if they've successfully repaid 20 credits and have only 2,000 euros in savings, a small economic shock and they're in the negative and they're, whereas someone even that has taken just one credit but has some financial reserves can go through those problems much more smoothly. So what kind of behavior do we want to see? What is that positive behavior, again, that we need to reward? And in that sense, I think we should much more emphasize a strategic use of credit only for extremely necessary things, like, investing into real estate, which is impossible to do with savings virtually, or buying a car, or, but not necessarily going to your summer vacation or whatever,
Or just repaying your loans. Okay. Next question. It's rather wide encompassing, but it will touches upon a lot of the things that have already come to surface. My own experience in teams with the World Bank assessing financial sectors, that for us this is a no-brainer. To us, countries must have sufficient credit information systems available, and they have to have positive and negative information. Even when we encounter countries that do have the adequate infrastructure, we see that credit doesn't ever reach at least the lower sector of the market. Micro businesses don't get enough credit, consumers don't. And a good part, the reason for this is the fact that there is not enough competition in the banking sector. There are concentration of a few banks, and they cartelize, they control interest rates, they control everything. And I was wondering, and they are quite reluctant to share information, especially positive information. So I was wondering to what extent, in your opinion, a good system of credit information is in a position or would help improve competition in the banking sector, which is probably the key in a good functioning of the market. Let's now give the floor to Enrique and perhaps go the other way around.
Well, I think that the level of competition in the banking sector is an important factor. But I would like, and I think we have to somehow broaden the debate away from the banking sector. I think we have a number of market developments, some business trends that forces a rethink of what is banking and who is the provider of banking services. We are now in a context of changing consumer preferences. We have new technological developments, and particularly we have interesting and very specific regulatory developments, particularly in the European Union, that are forcing us to rethink what is banking. And perhaps out of the number of regulations that we have to implement recently, or that we are in the process, in fact, of implementing, I would like to refer to the Payment Services Directive 2 and what that means in terms of access to bank account information. As you know, according to the PSD2, now it would be possible for licensed entities called account information services providers to access account information of banks. In fact, quite a few banks are considering themselves licensing themselves as account services information providers so that they can have access to information of their clients in other banks. This basically is triggering a revolution in the banking sector, and now we are in the context of open banking. So open banking is what we need to look at when we look at competition in banking. And here, of course, what we can see is the emergence of alternative providers of banking services. We have fintech, we have non-banking, we also have market-based financing. So if you look at open banking and the revolution that is being unleashed here, I think the level of competition is fierce. So we should not just look at, for example, systems like Spain, where you have a number of traditional banks, big players, and then you come to the conclusion that there isn't that much competition and that has a bearing on the kind of credit information system that we need. No, I think we should just broaden a little bit the perspective. So I would say the level of competition is very high in the banking sector. Now, if we're going to be in an open banking situation where information in bank accounts is freely available to those that license themselves to have access to that information, the question is not the debate about positive or negative data or credit systems that have only negative or positive information a little bit out of date? Because in fact, we are seeing an explosion of data coming from the banking sector, maybe not the traditional credit data, the historical information that is kept now in our databases, but the explosion of information is multiplying. And therefore, somehow, this debate that we're having is a little bit outdated. In fact, what we are seeing is a number of alternative providers of, for example, scoring information, tapping into account data. It is not unrealistic. Of course, tapping with the consent of the client. I mean, we have not mentioned this, but it's important that we put it on the table. You can have access to that information provided there is consent from the consumer. So what we are seeing, in fact, is that on the basis of this bank account information, people that are not or has not been traditionally in the credit information ecosystem are able to create let's say, proxies of scoring that traditionally have been built on the basis of historical information. So just to explain that the level playing field, or that the playing field, is becoming increasingly much more sophisticated and complex. And from that perspective, I think that we are starting a revolution, and that we should assess competition issues from a completely different standpoint.
Thank you. This is very interesting. As a point, very well taken. But my experience, of course, is referred as a World Bank person with middle income and developing countries which have no such things, no such institutions, and therefore the competition is between 4 or 5 chosen ones. So the answer still stands as relevant. Let me move on to Martin, perhaps, and I mean, go on if you want with this part, but also address the question of just a situation in which there is no proper competition.
Yeah, I mean, I think first of all, I mean, we should be humble about what data sharing can achieve in terms of competition. Let's not forget that it is not necessarily easy to set up, a new lending model. We've seen some crowd lending platforms developing, but I think, I don't know which one, but one had a real near breakdown because their lending model and their big data analytics system just wasn't as good and as tried as what the banking sector was doing. So their interest rate was still very high, and they've virtually almost went bankrupt. So I think, in terms of competition, the state has to play a role in terms of stimulating different offers available. If you only have the traditional huge retail banks, they only target a specific consumer profile. If you don't have a social or microcredit lending, for instance, if you don't have credit unions, for instance, all of those have a different business model, different philosophy, address a different public, and I think it comes down to antitrust laws. It comes down to trying to stimulate the emergence of competition and competitors. It doesn't emerge spontaneously. I think the state has to intervene in a certain sense to avoid cartels formation and to stimulate the creation of or certain types of business models so that you always have an alternative. And that's applicable to all the sectors, actually. So.
Right. Given that answer, if you don't mind, I'll pass the word on to Dolores, who, being a central banker, might have something to say about that, and then Federico will wrap up.
Well, I mean, it is true that being precisely a central banker, there is a lot of what Enrique was saying that is out of our classes at the moment. It's something that obviously all central banks are looking into it to see which is the way in which, I mean, it has been mentioned earlier on, I believe it was by Professor Padilla, the question on the supervision of these new actors, etc. There are many aspects in there that are still to come. I'm not sure the debate we are having is actually outdated, but it's true that we have in front of us a new world of new actors in the financial market, either in the credit or in the deposit side, and as you rightly pointed out, in terms of using the information provided the consent of the user. Just picking on it, and as a very short anecdote, the crowd lending platforms in Spain, one of the, let's say, commercial arguments that they are putting into the table is actually that they don't have to report the data to the central credit register. I mean, it's as easy as that, as an incentive, let's say, for, either second opportunity, bad payers, as an incentive for them to actually request, crowd lending platforms that are advertising themselves as we are free of the requirement to report to the CCR. You can get financing, but you will not be appearing on the information that is distributed within the system. So I think it's actually a very important thing that we will need to look closely from the regulation authorities, etc. But it's difficult to see how it's going to.
So should regulation fix that?
First, I think we need to, as Professor, the previous speaker, Maria, Thank you.
I know.
Yeah, Maria. I was trying to get your Polish name, but I was too ambitious. As Maria was saying, well, the European Commission is also looking into this in terms of the regulation. First to know and to see how it's working, and then when this is the case, then the regulation perhaps should come.
Federico?
Okay, my initial comment starts with a question. I wonder if this issue of competition, as probably you have anticipated, is more relevant for emerging economies, and I wonder if some economists can maybe say something about mature economies if the same would then apply. That said, if I can Europeanize this debate, yes, I understand and appreciate all the economic theory about competition. I think there is something that, however, needs to be touched upon, and this is the principle of reciprocity that dominates most of these systems, because these systems feed only if those who take the information also give the information. If we look at competition about new entrants, now let's talk about these new entrants. If these new entrants enter the market through a takeover or emergent inside the country, they probably take over also the system, the information they give and they take. But if it is cross-border, or if they decided to set up an agency, a subsidiary from scratch, they probably would not have anything to give. I'm not sure this fits well with the system. And this is where probably we need to anticipate talks about standardization of data so that those who come from other places can contribute to data in a standardized manner. But then talking about standardization also digs into what Maria said earlier about, yes, but what data are necessary, data minimization, basically regulation of what data. And what data are necessary. And this, in turn, digs into the issue of contribution to a system becoming mandatory. Because if the system is voluntary, and this is also in mature economies where private credit bureaus dominate markets, and there are no public credits, such as in the UK, for example, if it is a voluntary, then all this becomes frustrated, and this also becomes interesting and important for what we've been saying about new technologies and fintechs, for example, and what Professor Padilla said earlier about fintech not being obliged to do any reporting, while the other market players would be obliged to do the reporting. So in countries where the system is voluntary, probably this is not already happening. A very final point, also to react to something that Professor Padilla said earlier, I very much agree with him that the least thing we want is to have an information monopoly. At the same time, we must consider that credit bureaus are natural monopolies in economic terms. And therefore, I think at some point we will need to discuss about competition also in the information infrastructure. In the telecom communication, this has happened, that the network has been detached from the service providers. Information is a monopoly. It's a natural monopoly in economic terms. At some point, I think we need to discuss also about not only competition between financial service providers, but also those who supply the information too. Sorry if I have moved up the...
That's good. Before we move on, Enrique wanted to say something. May I remind panelists that there is simultaneous translation, and therefore might need to speak a little bit slower.
Yes, I just want to bring to the room the example of Australia. And why? Because Australia is a country that, contrary to the European Union, they do not have this enabling legislation that I was referring earlier about Payment Services Directive, and they are not yet into the open banking space. So we could in fact draw a parallel between Spain and Australia on a number of issues. Just first thing, Australia is also a banking system dominated by 4 big players. It's a system where there was a voluntarily reporting system of credit data information, and is a system where it was not foreseeing the sharing of positive information. It was a negative information only system. So they started a reflection a few years back on, well, what is going on in the rest of the world, what is going on in Europe, And they started entertaining the idea of comprehensive credit reporting. And there was resistance from the banking sector to sort of move to comprehensive. They were voluntarily contributing negative information, but of course what was in the debate was something else. After a process of reflection that I think is very interesting to monitor and to study, there was a commission, and it was called the Productivity Commission, that eventually recommended the government to force make reporting mandatory, and to make it first obligatory on the largest players first, in a first step, and then going forward to the smaller players. And they gave them some leeway, a few months, to, let's say, get to certain thresholds. Still, the banking sector did not use the opportunity to do it, and eventually the government had to intervene and to make much more demanding thresholds of reporting information, and in an accelerated time frame. This very much tallies with what Martin explained about, at the end of the day, trying to put some sort of regulation or to force some progress via regulatory intervention. And I think it is something that we need to take also perhaps into account in other developed markets. I think the good thing, or the thing to learn, is that there will be a slow take-up by the market if you force positive information to be shared. There will be some resistance. You need to have some regulatory intervention. And I would say the most important thing is that the process of evolution from one system to the next takes time. It has to be thoroughly analyzed, and that is why there was this Productivity Commission that did a lot of analysis, did a lot of stakeholder consultation too, because you also need to make sure that there is awareness in the consumer domain that we are moving on to a different system. So I would say that perhaps I looked at the Australian example with my Spanish lens, because I come from this country and I know the country better. But I think it would be a good example or a good sort of case study for Spain to look at.
Thanks. All right, so let's move on to the next question, because time's running up. Simple question I'm going to ask Martin to address in the first place. Would you prefer a system of credit information that's public, one that is private, perhaps a mixed one, and why?
Well, I think I make no mystery of being a strong supporter of a public credit register. And there are many reasons to this. First, there's a lot more transparency on how it's functioning, because it's mandated by law. It's very clear. It's very clear who holds the data. It also, you can mandate by law the aims of the credit register that it pursues. So, for instance, the public credit register in Belgium has an overt mission to fight over indebtedness. It is one of their aims. And within the more recent regulation even, there is even more regulation to make sure that the banks are those that have to prove that they've done the creditworthiness process correctly. Otherwise, they may face, fees or penalties. It's also freely accessible for consumers. So consumers can access it free of charge. It's very easy by plenty of different means. Online, they can easily access it with their ID. They can go to the credit bureau's offices. It can more easily correct mistakes. So they have a real process in law to be able to fix mistakes if there are any. They, for instance, have an automatic notification feature in case a consumer goes into arrears to help fight over indebtedness. You can check the quality of the data much more efficiently because the banks are obliged to feed the register with information. If they don't do it, then they get really, penalized. And even the operational cost is much lower because you're not having several organizations managing partially completed databases. You have a centralized database which is much more cost efficient in terms of managing the data. And obviously, the data that is included in the register has to follow strict legislative procedures. So you cannot just decide tomorrow that, because the market is moving in a direction, let's now use Facebook data. That's not possible. Has to go through a legislative process with a due debate. And finally, I'll just say that there are certain governance provisions that are very interesting. Like, for instance, having consumer organizations on board, having data protection authorities in the management board of how the credit register functions to see if it functions according to certain standards or not. And so all of these, I think, are what makes public credit registers much more interesting. And that's also why I asked the question to Professor Padilla, how do you actually make a business case for private credit registers once you have this kind of mandatory feeding certain data mandatorily into a credit register, and you limit the scope of the data used? It's difficult for me to see the business case.
But wouldn't you just address most of those problems that you described, or advantages of the public system ahead of the private one, by simply regulating the private sector and ensuring that they include the proper information?
Well,
and they have.
Yeah, you could, but then I don't see the point of having several of them.
All right. Okay.
That's the thing.
Okay.
If they all have the same information, exactly the same information, restricted, and they operate exactly according to the same rules, I just don't see the point.
Okay. So the point would be either one.
Yeah.
Right. Enrique.
Well, at the beginning of my presentation, I said to you that I represent a very heterogeneous constituency of data infrastructure, so to say, private and public. So it would be tricky, very tricky for me to say I prefer one or the other. So what I would say is that I would like to follow up on your point. You can have, as a system, you need to define a number of objectives. And those objectives, in fact, if you look at what happens currently, can be achieved or met through, let's say, purely private data infrastructures, hybrid models. You have in some member states hybrid models. You have also some private infrastructures that are licensed, and we have a number of examples in some European countries, like in the UK, for example, licensed by the Financial Conduct Authority, in Sweden, licensed by the Data Protection Supervisor. So you have a number of models, and what I would say here is that at the end of the day, the fight against, for example, we are in this conference talking about insolvency and consumer indebtedness. The fight against these two, for example, is very much a national issue. And at the end of the day, one thing is just to look at the infrastructure, but we need to look comprehensively at the system. What is a credit reporting system? And it goes beyond the data infrastructure. It includes local regulations, it includes some cultural aspects. So I think rather than picking up one or the other, I think what we need to do, or what countries could do, they should sort of try to enhance the enabling factors that make the credit system adequate for that country to flourish and to emerge and to improve. So I would like to avoid this one or the other. I think it's also very much what the World Bank, in its general principles about credit reporting, comes to recognize that every country evolves in a particular way and needs to make sure that the enabling factors for the best and the most adequate system for that country emerges.
That's correct. Yes, Federico.
On this occasion, I have to contradict myself. I will take a strong position. I'm in favor of public credit registries for the reasons that Martin has already explained, so I'm not going to repeat them. I give importance to the rule of law, and also the consideration that the fight against over-indebtedness, that is this theme, is a problem of the state. As a second best, I can accept private actors, but under public supervision and regulation. I would say more or less it could deliver the same advantages with the benefit that the usual criticism that the public sector underperforms is the usual criticism that most of the times the public sector is not competitive. Let's put it this way. I can dig more on this. Certainly, I'm not for pure market forces into this. I want to reiterate that information is power, and this also creates to me a problem of competition, because, as I said earlier, if we monopolize all this information in one player, I feel this is certainly a problem, and I don't see competition here unless we change things are organized, because there are other issues at stake, such as the data protection, that does not help to explain then why we could justify more than one database having exactly the same information. And moreover, to be complete, I said again, it's a monopoly, because otherwise a database that is not complete is not very helpful. To conclude, in this view of having public bodies or under public supervision, I'm very much hopeful in something that probably my colleague will talk about later on the possible role of unaccredited and the standardization of that at the European level, also for the consumers. That's to conclude.
Okay. Lola, stick to this question.
Yes, I will not enter into the next one, because actually, well, perhaps I'm going to be a bit surprising, just to take over from Federico, but well, I'm heading this public register that we have in Banco de España, and I actually think is essential that it's in there. It works well. Reporting agents are, let's say, limited to a certain financial players. There are other potential reporters that are not included. They are not obliged. It's compulsory. Data sharing is also compulsory, etc. So, and the objectives for which this credit register is built, is working, are precise. We don't have this. I will be having a very interesting look to the Belgian case. We don't have as a target to fight over indebtedness. We leave this, we provide the data, so the private banks, which are contributors to the credit register, actually use this data in such a way. But we miss many players that actually provide, or with whom debtors can get. I mean, we don't have any information, negative information or positive information on big utilities companies, for example, which I think is also a big source of perhaps indebtedness. They are not obliged to report, and we will not, because of the functions which were financial stability, provide information to the system, to the banking system, etc. I don't see how this could be integrated potentially in a central credit register. Perhaps it should change completely shape and then go into something different. But at the moment, I think this mixed approach, the coexistence of private bureaus and public central credit risk register should actually cover more than would only cover the central credit register of Banco de España.
Very quickly.
Yes, very quickly. I wanted to support this because we were, of course, just talking about traditional credit data, but there is non-financial information that many of the members of ACCIS also gather. And there are many products, call them ancillary products, that, of course, a central bank or a public entity would not be comfortable perhaps in offering, like, for example, scoring or added valued products. So I think in those countries where we have the two systems, hybrid countries, so to say, I think there is a natural decantation of options and a good complementarity between the systems.
Can I just say something?
Yeah.
Because I understand that, but where non-credit data are used, if the credit data are used for the prevention of indebtedness then from the financial providers, that's one thing. But then if these non-credit data are also given to those who contribute the non-credit data, I have a problem with that. If you start giving this data to landlords, if you start giving this to utility companies, if you start giving it to telecoms, you're doing a social butchery. You risk doing a social butchery. Can you imagine these actors receiving all this data and making decisions on renting properties, giving telephone services, the cost of utilities? We have to be careful.
Not only we have to be careful, we have to be GDPR compliant. So I think that is not an issue. It is an issue, or it is an issue for every market operator, for every company that is in the business of processing data and sharing data. So this is perfectly recognized, and that is why I can tell you the top item in the board of all the private credit bureaus now, today, is GDPR compliance and how to make sure that this is done put in place and that the consent is gathered and et cetera, et cetera.
If you must go.
No, sorry, I must react to this, sorry. And I don't want to take over your panel later. Please, be aware that the GDPR can be a false solution to the problems I've just put on the table. The GDPR relies on mostly consent, legitimate interest, and until then we don't realize that in these situations there is a clear imbalance of powers. Yes, you will be compliant, very good, but we won't going to solve any problem because you know well, better than I do, that the GDPR can be easily frustrated by way of consent or legitimate interest. Probably later they will touch upon this.
Yes, very quickly, just 2 points. First, on non-credit data, utility bills. Don't forget there are a lot of false positives. So, for instance, you have utility bills companies that overcharge consumers, and consumers know that if they pay up, it will be very difficult for them to regain the money. So what they do is they contest the bill, but then they may go into negative. So that's one thing. I think what the most important point for credit registers, especially public credit registers, is to indeed close the gaps in terms of the ongoing financial commitments of the consumers. So I think in positive data, for instance, to clarify, it's less important to know what credits a consumer has successfully repaid, but to know at a certain point in time what are his ongoing financial commitments. How many credits does he have ongoing, active credits in other banks, which might cause detriment to his income and to his savings capacity and his reimbursement capacity. That is more important than successful repayments of previous loans. And in that sense, the public credit register in Belgium did close the gaps in terms of credit cards and all these things. But again, what is nice is that it's a public debate. And it has to be voted on, so it's not just an arbitrary decision from private credit registers.
Okay, thank you. So we come to the very last question, which we will try to answer very quickly so we can have some debate with floor. Previously, Professor Lisowska mentioned that the European Commission has on the agenda, or at least has identified, a problem that's evident to all of us, which is when it comes to cross-border lending for consumers. The diversity of legal systems and especially diversity of enforcement mechanisms makes the whole market difficult. It's not really a very streamlined. The possibility of having a streamlined market is severely reduced in a way. So I was wondering to what extent, in the opinion of my co-panelists, the existence of these separate, disparate enforcement mechanisms is unsurmountable, is something impossible to overcome, or is something that we can work on and perhaps reduce and make credit reporting systems useful. Perhaps Lola will start with this one, yes.
Well, it has already been mentioned, this question of ANACRED. We are also talking about the different backgrounds for different countries, different regulatory schemes, etc. There are some European countries that do have long-term standing public credit register. There are others that have none. And we are talking about harmonizing these very distinct things. So there is this project that was started up, formally in 2011 to create this harmonized database on credit data, for which all the Euro countries would be obliged, would be compulsory for all banks in the Euro area countries. Non-Euro area countries banks can actually join. The countries can join on a voluntary basis. I believe it will be a major achievement. The regulation was approved in 2016, last year, and the first data should be reported actually in 1 year time, because the first reference data would be September 2018, to be delivered basically mid-November, so in 1 year time. Again, it's a loan by loan database. It will only be collecting data so far on legal entities, only from credit institutions, and only above 25,000 euros there is a reported.
So nothing for consumers.
Nothing for consumers. This actually, well, I mean, I'm not going to tell you all the discussions that were there. I'm also new, so the discussions was already done by the time I arrived. But it is true that the question of the consumers' data, the personal, not even consumers, but natural persons' data, even in their capacity as entrepreneurs, was basically on the table. There was a question from the Ombudsman of the European Union. There was a question on this when the regulation was being worked on in the European Parliament. There was a very high concern, very, very deep concern in terms of which data on natural persons could actually be stored in that database. So actually it's going to be a long-term project. There is there are lots of things that need to be made convergent in the way in which European things do converge, which sometimes is let's converge by doing things. So it will be done in phases. The first phase is, as I described, legal persons, only credit institutions, only loans over 25,000 euros, and in future phases that will be studied and projected in the future. Let's see how this first phase comes, because it's not being easy already. Well, there will be more financial institutions included, and again, I'm talking about financial institutions and not other things. There will be more products. At the moment, it's only loans. There will be other things, and also eventually, perhaps, also data on natural persons. But I believe this is still some time to go.
Perhaps Maria can illustrate us a little bit on that later. Federico, let's be quick so we can have 5 minutes of debate at least. Yes.
No, yeah, I see it. The future is data standardization under the rule of law. The question, I reiterate, is what data. So the principles to be followed are data minimization and purpose limitation, and also the rule of law should establish what uses to be done. And I believe again that the public institution can guarantee the uses. And that data is not used otherwise. On the AnaCredit project, finally there has been the connection between between problem debt, of course, and the prudential supervision of the system. Now it has become apparent, especially with the financial crisis, that also consumer over-indebtedness can have systemic effects and problems about the financial stability of the system, and therefore I encourage also consumer over-indebtedness to be part of the prudential supervision of the system, because consumer finance is becoming too intertwined with the economic stability. Or what?
Enrique?
Data standardization, I think it is. Data standardization, I think it's clear that it is coming. I mean, we have discussed the AnaCredit project, that I think it is certainly very ambitious and is going to introduce a lot of harmonization. But we have other initiatives that are forcing a rethink of how we use credit data. For example, the biggest, I understand, political concern these days in Brussels is how to tackle the non-performing loans. And in the context of how to tackle non-performing loans, there are some ideas that are being entertained about or around the creation of secondary markets for investors to come into a non-performing loan secondary market and buy and sell. Every secondary market, of course, as you can imagine, needs some common understanding, definitions, data sets, so that investors understand and are able to compare. So yet again, another area where we see some data standardization coming, and I think it is important. One thing that I would also like to say is that even though we may have heterogeneous credit enforcement systems across the EU, that is one debate. But another debate is to what extent we should sort of try to converge or introduce some level playing field on data availability across the EU. And I think here we can make really a lot of progress, because I was explaining that in my membership we have some countries where you have only positive information, negative information, others where you have positive and negative information. In some member states only a subset of the economies contributing to the credit infrastructure. In other member states, more players are contributing. Access to the database is also different. So in the context of the principles that Maria was referring earlier, how can we deepen cross-border retail financial services in Europe? One of the things, perhaps as a preliminary step, we need to make sure that we are able to arrive more to a more level playing field in the different member states on data availability and data access. So we have data access, data availability, and data standardization. And all these three can progress, I think, quite independently from the harmonization of the credit enforcement mechanism that is slightly separate.
Wrap up, please, so we can move on.
Yeah, okay. So I just like to say that indeed I think it's absolutely crucial that we harmonize, because we are moving into a big data kind of world where there are novel ways, exploratory ways of tackling this issue of creditworthiness, and not necessarily in the interest of people. So I mentioned, I'll mention, for instance, Bloom, which is a fintech that relies on blockchain technology to do creditworthiness. And one of their systems is to use the web of trust to be able to assess creditworthiness, where individuals have to rate each other. And so you vouch for some of your friends to be good, creditworthy, and if they end up not being creditworthy, you're penalized, which is, I think this is a nightmarish scenario. And so I think we do need to agree on certain, data that should be used, and with specific targets and specific objectives in mind. And so I think that in terms of the data availability, I think what I said is the best. If you look at how people manage their money, which is now with PSD2, it'll be much easier because you can actually track them across multiple accounts. You can just see very clearly if the level of their finances is growing, is lessening. Can they save money? Can they manage it responsibly? If somebody has savings, I don't see how in that world they would not pay utility bills. It's just crazy for me that someone manages their money responsibly and doesn't pay their bills, or doesn't do these kind of things. So in a world where we may be tempted to look at, and this is what I think, if you look at growing data sets, what you're actually trying to do is for banks to be able to tell, in a hypothetical world, if you were about to default on your credit, how likely are you to sell your kidney in order to pay for your credit or not? That is the kind of world we're going into. Banks are just, objectively people that have almost the same risk. They're trying to still differentiate in order to attract more attractive or more interesting consumers. So the consumers that would rather sell their mother before going into arrears. And I don't think that's the world we want. I think ideally, either you're creditworthy or you're not creditworthy. If you are creditworthy, then you have access to the best conditions. And it's kind of the same thing if you think about public health or all these insurance schemes. Everybody pays a sort of default rate, because it is assumed that everybody that it's by chance, everybody has an accident of life, and it's by chance that you have that accident of life, except if you have some moral hazard. So if you're a smoker, for instance, then you pay a little bit more. And that's what we need to identify. Banks could actually lend at a standard interest rate, for all consumers, if they can first mutualize and socialize the risks of accidents of life, and if they can, weed out moral hazard. And I think that can be done with a sort of a restrictive amount of data, which I've discussed, in the beginning of our conversation.
Thank you very much. Right, so let's have 5 minutes for questions. Anyone? ¿Alguien tiene alguna pregunta que hacer, por favor? Profesor Padilla.
To be absolutely frank and sincere, I think that with respect to this debate about positive versus negative, I think that what I would like to contribute is that if we're talking about consumer credit, I tend to agree that the moral hazard is relatively a less significant problem than adverse selection, that heterogeneity. And the only reason in order to restrict the exchange of information to negative information would be that you have a very significant moral hazard problem. So I think that if you agree with me that consumer credit is more about adverse selection than moral hazard, then it is a no-brainer that we should have positive information involved in the credit bureaus, and the credit bureau should major on positive information. And my second comment is about public versus private. I think that I'm sort of less negative about private than I think that some members of the panel. I definitely think that it would be great to have a public register because it would provide a default and would encourage competition. But I think that credit bureaus are not just about collecting data and hoarding data and storing data. They provide added value services, and you know, I think that I tend to trust that for innovation, competition is better than monopoly. And I think that in that respect, I would advocate in favor of a complementary system in which you have public and private. I think that my last point would be, however, I think we have to be aware of one potential problem with private credit bureaus, and that is restricted access. So you don't want to have a system in which only a subset of the financial institutions benefit from the exchange of information. Because if an information exclusivity is a barrier to competition and a barrier to entry, imagine if you have a club of banks or other financial institutions that exchange information between themselves, but not with others.
But that's the problem of public systems too, isn't it?
Right, and that could be a problem with public systems as well. And I think that you know, as we do with the standards, in which we require standards to comply with competition laws to be open and not to be able to discriminate against membership against potential members for non-objective reasons. I think that we need to ensure that that access is open also to the credit bureaus, and that everybody that wants to be active in the market has access to that information with some reciprocity in terms of the provision of data. Sorry for commenting as opposed to questions.
Thank you very much. Anyone in the panel wants to say anything about it?
Oh, no, just maybe on the point. Yeah, I agree to some extent, and accept that. I think that in fact the debate is positive, yes, but how much positive? How much data? I mean, if I can say so, for instance, I think I don't want to know everything about my wife. Everything. Oh, probably. I would take different decisions, probably. I don't know. I'm just exasperating this now, of course, for the sake of provocation. I'm just being provocative. But it's to say that if I know too much, I think that even in economic terms, there is a problem. Probably you're an economist, I am not, so probably you can tell us if knowing too much is a problem. But this is, again, this problem I'm pushing it to.
I think that it's an efficiency problem. I think that from an efficiency perspective, you will want to know as much as possible, even non-credit data. I think that, however, at one point, you have other considerations that are non-economic. Like, do you want to know whether somebody has a cancer? Of course, it's relevant from a credit point of view, because you know it shortens the time horizon in which you can repay. But I think that there are other considerations why you don't want to share that information, and so on and so forth. But from a pure economic perspective, you know, after all that they want to have is a best posterior probability of repayment, and all relevant information. And I think that I cannot think of any information that would not be relevant to some or another degree. Would be good to have. There are other considerations that are non-economic that prevent us from hoarding, storing, and sharing certain types of information.
You know why I asked this in a provocative manner? It's because probably this is the debate that we are start having with fintechs in credit. The information that is there. How much information is enough information? I think this is something that economists have troubled for a long time. How much information is enough information? I think this is a question that is very difficult to answer. But that's why I asked.
Let's leave this for a future panel. I think you would have benefited from a very classic Spanish saying, which is "ojos que no ven, corazón que no siente." It would have helped you.
In English,
you translate that.
Eyes that don't see, heart doesn't feel. Concerning your wife.
Say it again in English.
Eyes that don't see, heart doesn't feel.
Eyes that
yes,
don't see,
yeah.
the heart.
Yeah. We know
Just a very quick comment. Sorry, I just wanted to say that we have the choice now between two very opposing and caricatural scenarios. First, either we force a certain number of socialization, which is what happens in public health, for instance, via socialization of risk, and you decide where you draw the barrier in terms of law, and then competition is sort of stifled because of that decision. But it's a policy decision with certain policy aims. Or, and here I'll be a bit provocative, we're going into a world where we're going to untangle the free will. Because why stop at predicting people that will have, accidents or credit defaults. You can actually also look at the root causes, and there you might find surprising information. For instance, if you look at psychometrics, if you look at evolutionary psychology, if you look at behavioral economics, if you look at neurosciences, all of those are picking apart how humans behave. And so you can actually, in a futuristic world where indeed we use all the data, you could actually see how much a consumer is vulnerable to certain types of advertising, and if their behavior is due to their own decisions or an external factor. And so why would you penalize someone to make a decision which is not really their choice, but which is a conjunction of external factors that may be advertising, that may be, the models in the media that they've been exposed to, the education of their parents. And I mean, this is really the two worlds we're going on. Do we really want to untangle our free will and trying to pinpoint, is your decision due to 27% can be explained by, exposure to advertising, 52 by, the school that you've attended and the university. Do we really want that world? That's what I'm saying. And this is where, of course, it's convenient to stop at predicting, because obviously then you don't look at responsibility. But this is really the real core question. Once you start predicting, you can actually go into responsibility, and there it might actually be the banks that'll have to subsidize certain things because they might be held responsible due to the way they advertise and everything. So.
Okay. Thank you very much. This is extremely interesting. I'm afraid I have to stop it here.
I just have a very minor thing.
Very minor, yes.
Very minor. Yeah, I don't want to give the impression that an accredit is going to be sending back data to banks, to contributors' banks. This will be done through the central banks. What I mean is that in Spain, if in Spain there is a central credit register and there is already a tradition of sending data back to the banks, and a credit harmonized data will be sent back to the banks. If in Luxembourg, for example, there is no tradition, there is no feedback loop of data to the banks, that the fact that Luxembourg participates in an accredit doesn't make that this data travel back to the banks. It's a central bank decision. You said that we were talking about the access, the access of the data has also been mentioned, but I think this would lead us to a completely different thing. But I wanted to clarify.
Points well taken. Thank you very much. We are standing in the way of coffee, which will be reduced probably to 20 minutes only instead of half an hour, perhaps.
Maria wants to say something.
Half an hour.
Maria wants to say something? Oh, sorry, please.
Two little points. One is really standardization is necessary. There is no definition of default. There is no definition of non-performing loan. So maybe an accredit will solve it for business loans. The second comment is to Professor Padillo. I don't think it is moral hazard on the side of consumers being the major reason of non-payment. So the negative databases will not solve the problem. Okay.
Okay, thank you. May I ask, please, everyone to congratulate the panelists for the fantastic job. Thank you.